Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor. This is Dentist Money. Now, here's your host, Reese Harper.
And welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm your host, Reese Harper, here with my trusty old co-host, Sir Ryan Isaac.
Yes, welcome back from the great, dusty, snowy plains of Mongolia.
That's a whistle from the movie Iron Will. When Iron
was that
Will
the robot?
Tipped over. He's a sled puller, dog man.
I'm thinking of a robot.
Yeah, for some reason, I haven't watched that show in 15 years, maybe.
But you just got the whistle?
The whistle came back to me when I was in Mongolia watching wild dogs and people riding reindeer. I watched some people riding some reindeer.
Is this bareback reindeer riding, or do they saddle them up?
No, you can't saddle a reindeer, right?
Oh my gosh.
They're not going to appreciate that.
That's crazy.
Yeah, I mean, just imagine that you're...
Did they raise them in the captivity to jump on a reindeer's back, or do they...
That is still a research project I'm working on.
Okay, you'll know.
All I know at this point is that there's some people in the northern part of Mongolia that ride reindeer, and they refuse to ride anything else.
Well, coming to a podcast story near you soon.
We're going to be integrating that tale.
It'll happen.
All
right. Well, today we've got a great topic that was kicked off by a really good question in our Facebook group, which is probably a good plug really fast to say, go ask us, join our Facebook group and ask any question you ever want to ask. We go in there and personally answer them, and sometimes it's such a good question, we got to spend an hour talking about it.
Are there limits to what you can ask?
No.
No?
Will we ban you?
Well, in terms of will
Yes.
you get a competent response?
Okay.
It depends.
That's fair.
When it comes to successfully raising children and instilling moral values and work ethic among them, we're going to have a hard time with that one. Ryan and I are really struggling with that. Trying to raise our children.
That was a good question.
That's
but true.
We try. We're just not claiming to be experts in that particular area. We have some experience, some familiarity with the issue.
Yes, I have kids,
but
I'm probably screwing them up.
I would say if it relates to money, we're going to be better. Money and finance.
If there's a decision
business,
a dentist has to make around money
or his practice,
then we've probably seen it.
Yeah.
So dentistadvisors.com/group, that'll land you right in the Facebook page.
And or food, mountain biking, and skiing.
Yeah, food, shaving, I'm an expert.
Travel plans.
Vacation
preferences.
So this question came from, it was kind of on the heels of another episode. It was actually episode 180. It was a Q&A episode we did where we talked about somebody building a lot of their net worth in real estate.
I think it'd be on the toes of the
It's not
episode.
the heels? Is it on the toes?
The Mongolian toe boot, if you will. Yeah, it was kind of like we led into it, you know?
Yeah, okay.
I just wanted to clarify that because I've been thinking about the Mongolian toe boot lately.
And then the phrase on the heels.
Yeah, it just threw me off.
It doesn't make sense to you.
Yeah.
All right. On the Mongolian toe boot toes of episode 180, where we talked about building some of your wealth in real estate, this person asked, well, I'll just read the question. This is a really good question. He said, in determining one's total term, is there an ideal mix of assets in the bottom row that you look to accomplish by the end of your career? What are the effects of being too heavy in one versus another?
Yeah.
So if you're not familiar, just push pause after I say this and go to the website, dentistadvisors.com, go click on elements. And there's this table in the bottom row of the elements is where we track our clients, not only their total net worth, but we track how their net worth is made up. Is it sitting in liquid stuff, retirement plans, businesses, real estate?
Yes.
Mongolian sheep farms,
yes,
which would be businesses.
Yep.
So this person is asking, like, is there an ideal mix here?
Well, there's only four. And
there's only four.
For those of you, four general categories for those of you who do not know. Business equity or business interests. That's ownership in a small business. That's ownership in your practice. It's ownership of any private stock in any private enterprise you have.
Mm-hmm.
Then real estate is another category. Then retirement plans, qualified retirement plans. that have some kind of tax advantage to them.
Yeah.
And then liquid assets or investments or cash that you've already paid taxes on.
Doesn't have a penalty to grab it. Already
Those
paid
are the
taxes
4
on.
categories.
Yeah. So this person's asking, like, is there an ideal mix between these two that there should be?
Yeah. Great question.
The main overarching theme, or the thing people want to figure out here, the big question that a lot of people ask, I think it's on the website when you go there and you hover over that bottom row. Am I putting my money in the right places? That's really the right question, right?
Yeah, I think on the website it says, do I have the right mix of assets?
Yeah.
I think a better way to frame it, or more like people would think about it, is, am I putting my money in the right places?
Yeah.
We would, in our business, the way we look at this, we define financial planning jobs into really core kind of high level. We call them sometimes functional jobs. And then we have related jobs that support that core functional job. In this particular case, the core functional job that we would discuss today, we'll call it the main job.
The main question.
The main question, the main job that has to get done is, am I putting my money in the right places?
Yeah.
And that's it. That's what this person's feeling. And then in order to answer that, there's a lot of other kind of there's a few other related jobs we're going to talk about today, so that when you get done with this, you'll know for your situation, do you have the right mix?
So the first one is liquidity. And by the way, if you're familiar with this, or you go to our website, we measure everything for our clients in something called terms. What we're measuring is how long could a person live given their current spending out of that current asset. So how long could you, if you're still spending what you're normally spending, how long could you live on just your liquid stuff and just your retirement plans and just your practice if you sold it and liquidated, just your real estate if you liquidated and paid off the debts, paid taxes. So each one is in terms, So liquid term is how many years of liquid assets, given your current spending, could you survive on? So let's start on the first one, liquid term. What are the, what's normal for someone when they get to retirement? What percentage of their assets end up being in this bucket? I think that's a question people would have. And what are the pros and cons of overbuilding your liquidity?
Well, for me, the first one that comes to mind is, let's just say that to give people a starting point, the combination of all of these things is what we call a total term. And that we would say, at the point you're ready to be financially independent, I'd say the point you're able to retire, that could be maybe a 25 or 30 total term, or you have total assets, all your assets, you have about 25 to 30 years worth of all of your assets lined up. At that point, retirement starts to become
25 or 30 years of your annual spending.
Spending is meaning your net worth is 25 or 30 times what you spend in a year. That's the kind of the point we're having a conversation now, and we're saying, what's the downside of being imbalanced in liquid assets, right?
Yeah.
So like in this specific case, let's say we've got someone with a 25 total term, all right? And let's say 5 of it is in their house in real estate, and they got 20
in liquidity.
So they've basically built up everything. They've just paid their taxes their whole career. They've never done any retirement accounts. They sold their business now, and they've just got one house and a bunch of liquid assets, and they have no retirement accounts, and they don't have any ownership in a practice anymore, or any private business.
Right.
The upside of that is you're in really good shape. Like, you're in really good shape, meaning you've paid your taxes. You don't have you don't have any tax risk anymore. You meaning you don't know you
income tax, right? Like, you have capital gains if you sell some stuff out of your
and you've hopefully managed it well throughout your career, which is another job that you need to do.
Yeah.
As you invest in these after-tax accounts, you shouldn't be deferring your capital gains your whole career. You've got to manage those either through charitable contributions or tax loss harvesting, changing positions out during down years. That's what tax loss harvesting means. Anyway, you've got to make some. That's a related job. Want to make sure no one forgets about that one.
Yeah,
but
kind of important. But
liquid assets, as you build them up throughout your career, they're really the most secure high, like if I was going to have one category to be overweight in,
yes,
I'll take that one.
Yeah. If there's one category in the whole list that's like you're way overweight, that's the one that'll probably feel the best to be overweight.
Oh yeah,
because it's already been tax money. You can have $5 or $50,000 out of it.
Yeah,
your discretion. Do whatever you want. Invest it however you want.
Yeah, in terms of like, imagine it feels very different than if it's all in real estate or if it's all in a business. Or if it's all in a 401k.
Mm-hmm.
So we won't get into those yet on the pros and cons of those. We're going to stay with this liquid one.
Yeah.
But that's the upside, okay?
Yeah.
The downside of it, to me, okay, the downside of it is all things being equal, okay? All things being equal, meaning two people, let's say you have two people that worked for 30 years making $250,000 a year.
Mm-hmm.
And one person didn't do any 401k or any retirement plan contributions, and the other person did.
Maxed it out every year.
Other person did. The person that's all in liquid will probably have total a much lower net worth overall, because when you do retirement accounts and you do get the deductions for those accounts, all things being equal, let's say they spend the same amount of money.
Yeah.
Everyone's spending the same amount of money. It's just the person that that does the retirement accounts, or the person that, we won't jump into that one, the person that only does the liquid accounts, they're actually going to pay more taxes during their career.
Mm-hmm. At the highest
earning point they've ever been at, and they will likely they will have a lower net worth, and a lower, like this person will be if they're at a 25 total term. The person that did retirement accounts and liquid would probably be at like a 33 to 35 total term. If you're going to commit to doing qualified retirement plans during your career, you have to save
the
difference. You have to save more money. You should have a higher savings rate than the person
there you go.
that did not do them.
Because you paid less in taxes.
Yes.
Okay.
And that, to me, so that's the pro is it's awesome.
Of liquidity. It's easy.
It's easy. You just get to pay your taxes and move on.
Yeah.
A lot of people choose to do that. You'll see how a lot of people argue for that approach. Just don't do any of this crazy retirement plan stuff. I can buy into that if you want to pursue that strategy. I don't think it's entirely
if you
rational.
Yeah.
But I can understand why people would do it.
Sure.
I can
for the ease
understand
of it.
If you're the type of person that throughout your entire career, you maximized your liquid assets, meaning every year that you could have, you just saved and saved and saved the money. You didn't hire a new associate. You didn't open a new location. You didn't expand by, taking out another TI loan and getting the practice larger.
Yeah.
You kind of just you prioritize stripping the business of its cash and saving it into
pay taxes on it and then saved it. Yeah.
If you did that, you probably didn't have as large of a practice as you could have had, which is it's a fine path to go down. The only reason I'm saying that and giving you kind of the view of the acute during your career that probably happened, because there is a possibility that a person with a 25 total term, 20 of it being liquid and 5 being in their house, they did prioritize their practice and they just sold it at the end and got that whole amount of liquidity.
Put it in the liquidity anyway.
So,
which is another.
It could have happened. We're talking about two different scenarios here.
Yeah.
At retirement versus accumulation.
It's kind of like the Big Bang, like right at the moment of Big Bang, but like what happened 1 second before?
Yes.
Yeah,
and if you're the type of person that right before it was a 25. You were at a 30 total term and, 25 of it's in practice equity.
Yeah. And you sold it, paid the taxes, then put it in liquidity.
Yeah. Then maybe you did aggressively grow it.
Yeah.
But that's the challenge of probably to your question that came through is along the career, that's the trade-off you're making.
Okay. Is
you're saying bird in hand, I'm going to put some money in my accounts and save it and invest it. Build my liquidity because I know that's for sure gonna retire me, and alternatively you could invest that in retirement accounts and your practice equity,
or buildings,
or buy a building and real
estate.
I mean, there's some opportunity cost to that.
Yeah.
So I think that's your
Okay.
thoughts on liquid.
That's liquid. Okay, let's move to the next one in the bottom row. What'd be cool is if someone is actually like on the website listening to this and they're just following along like a chart,
Yeah,
just on the elements chart, you know?
they'd enjoy it.
You would, or if you came to one of our events and you got one of our awesome new Elements T-shirts, and you listen
Yeah.
to this while looking in the mirror or just looking down and
Then you
pointing to
could-
your T-shirt.
Then you could know. You'd just be like, look, I'm pointing at my tee.
You could just like on bottom row right now.
If you want a tee, I'm going to shout out special offer right now to anyone who wants a tee. If you're listening to this,
Follow.
if you're
We get
listening
a
to
little
this,
contest here.
join the Dentist Advisors Facebook group
Oh yeah.
and request your tee. And if it happens, for the first 10 people that request their tee, we
Okay,
give out
that's
free
fair.
tees.
That's fair. I was gonna say the marketing team is gonna hear this and be like, "All right, what did you just do?
You just blow up my life.
Wait, what'd
Okay,
you-
we're limiting it to 10.
We're not a T-shirt company. Like, what just happened?"
limiting it to 10.
All right, number 2 would be qualified terms. So this is the element where we track how much of somebody's net worth is sitting in qualified retirement plans, which is just a fancy way of saying pre-tax retirement plans, stuff you put money into that lowered your taxes that you'll be taxed on later, that you can't touch till you're 60.
Yep.
So
Okay,
we're talking
pros and cons.
IRAs, 401ks, simples, SEPs, profit sharing, pensions, cash balance, that kind of stuff.
Yeah. What's a pro?
Well, the pro immediately is what you were just saying, which is the person who maximizes the most efficient retirement plan for that year, every year of their career, is going to end up with a lower tax bill throughout a whole career and more cash and liquidity to save along their career. They should have a higher savings rate.
Yes.
All other things being equal and done right.
Well, Ryan's saying, let's say someone's making $250,000 a year, and if they do it all into liquid, we're saying maybe they'll only be able to save, $40,000 a year. But if they maximize the most efficient retirement plan for their situation that year, maybe they'll save $60,000 a year.
Mm-hmm.
So you go from saving maybe $4,000 a month, or saving $5,000 a month, or $3,500 to $5,500,
Yeah.
maybe, or you can be higher depending on the type of plan that you construct. So you should have more actual savings dollars that get put away, more to compound,
Mm-hmm.
and a higher net worth
Because of that, should
because
result.
of that.
Now, I'm just like sitting here thinking, if you're looking at this chart and you just move your finger up to the middle row, that the middle row is what you have to know in order to make sure that tax savings actually goes somewhere useful and doesn't just get spent. The middle row is where does my money go?
Yes.
It's saved or spent or taxes or debt.
Well, the middle, let's say, where does my income
Where does my income go? Where does my income go? And so, yeah, that's the huge caveat with this one that you were just saying a few minutes ago too. I mean, if someone, it's not going to benefit you unless it's being monitored and tracked, and you know that extra $10,000 of savings that year actually went somewhere.
Yep.
To build your net worth.
Mm-hmm.
So that's the pro then.
Yeah.
Is what about cons? Like, now it's actually like more common for the typical average American worker to have most of their retirement assets sitting in a company 401k.
There's a couple of con artists.
Remember Con Air with
Nicolas Cage
Nick Cage
and bearded guy. It's Russell.
I don't remember him. I remember Steve Buscemi. He was the crazy guy that had like all the
Con
dolls.
Air had
Con Air was so
who's
good.
the guy that's the coach in Glory or the hockey movie? He's the coach of the U.S. Olympic team.
I don't know. I can't remember who you're talking about. I just remember Nick Cage. He had like a skullet basically. Well, John Malkovich.
No.
So you had Buscemi, Malkovich, Ving Rhames, John Cusack. Oh, this Chappelle was in there.
It's a great show.
Okay. Anyway, the cons, multiple cons of Con Air.
So, the con of 401k, IRA. Well, the con of one of the cons
Of overbalancing, because that's what we're talking about, being overly concentrated.
One of the cons is when you get to retirement, you're not only pulling out money out of this account and spending it, you're also paying taxes on the money that you pull out and then spending it. So it feels like it just feels maddening to some people.
Yeah, like they've already I've already
paid
gone
taxes my whole career.
Can I be done
now I
with
got to
this?
pay them again.
Yeah.
And sometimes they're just mad at that.
Now, a counter argument could be, I'm a high income earning dentist throughout my career, and the money I pull out in retirement to spend is far less than what I pay tax on along the way. So maybe my actual rate that I'm paying is lower in the future. Maybe
it will be for most people.
Yeah, so maybe that ends up okay. But the other con is during that entire 30-year career, that money is not liquid. And no matter how many times someone says, no, this is 20-year money, I'm never going to touch it. Like a few times in a career, there's just, you touch the money.
Yeah.
You get it. You need it.
And another con that I see quite often is not only you have to manage your retirement plan very efficiently in order for it to actually be better for you. Because when you do a corporate retirement plan, you are going to be matching money for team and matching money for employees. And dentistry is not an industry for the most part to where employees value that benefit.
Participate that much, yeah.
They don't value it that much. And if you do pay a significant percentage of your income, I've seen mismanaged retirement plans quite often result in massive amount of money going to staff.
Oh yeah, that don't even care.
That don't value it. I have clients doing meaningful employee contributions, but they're getting a ton of money away from themselves too.
Yeah.
And so this is a big question. It's a con of the qualified retirement plan part of your net worth.
Yeah.
This QT area, and that if you accumulate a significant portion of your wealth in that type of plan, there's a good chance that you probably gave a lot of money away to team that you may not have needed to give away. And there's a good chance you might have incurred a fair amount of admin fees in order to manage it throughout your career too, because you're paying $1,500 or $2,000 a year.
They're more expensive than a brokerage account.
It's more expensive than a brokerage account, which is your liquid assets. Ryan and I aren't like 100% convinced that you have to do the qualified retirement plan to retire. And in some cases, people that don't do them might be better off than the people who mismanaged the plan, the retirement plan, and gave too much to staff and, didn't maximize their annual contributions anyway. They didn't even keep up with their maximums. They never upgraded their plan
or their tax savings never went anywhere anyway, just like sat in a personal checking account.
Yeah, if all you do is fund a 401k and then don't save more money than the person that didn't. Let's say both people save $20,000 a year. Well, if two people save $20,000 a year and one's going into liquid accounts and one's going into a 401k, I'd way rather take the guy or gal that's saving into liquid accounts, because you can have an effective net worth that's way higher. But the person saving into 401k should be saving $35,000 compared to the person that's saving $20,000 into liquid.
Yeah, it should be more.
Yeah. Should be way more. So you just have to make sure and get all those things right. That's a con. So cons are, it's a pain. It takes time. You have to match staff. This thing has to be outsourced, and you can't just outsource it to a 401k provider, because you all know how that will work when you just hire a TPA to do your 401k, and then they're like, yeah, we'll help you think through this.
Yeah,
and then,
spoiler alert, they don't do the planning for you. And they're great people and wonderful companies, but that's not their job.
They're filing your tax return. Kind of like where a lot of you are probably frustrated with your CPA some days, because you're like,
he should be doing all my planning.
They should be doing all the planning. It's like, well,
no,
they're doing your filing of all your returns. That's a real hard thing to do too.
Yeah.
And you're not, in some cases you're paying for planning, in some cases you're not. If you're paying $1,500 a year to file your tax returns, the chances are you're not going to get any tax planning for that. You're just going to get filing my return.
Yeah.
And
it's a job you paid for.
And so when it comes to this qualified plan stuff, someone needs to be paid for planning and thinking.
For thinking. Yeah. Paid to think.
You probably won't. The industry evolves too fast for you to figure it out. And this is probably one of the number one reasons why financial advisors will still have jobs for the next 30 years, because it's just getting more complicated by the day.
Oh, yeah.
Actuarial science is getting more complicated by the day, and the government keeps regulating the retirement plan industry more and more by the day. But the person who does this well, okay, the person who really does a good job in this area will have a higher net worth than the person that just says, you know what, passing on it. I'm just going to do liquid assets and real estate.
Just call it good.
Just going to call it good.
Yeah. Okay. All right. Those are pros and cons.
First two.
Those are first two. The third one.
What's the third item?
Number 3 is practice in private businesses. So this is how much of your net worth is sitting in your practice or other privately held businesses that you own.
What's the upside of this?
The upside of being overly concentrated in this, I would say there's caveats here. If you did it well, like if you were a good entrepreneur and a good business person and you made good decisions.
So how do we objectively define this? It's pretty easy in my mind. So you go, okay, you made $250,000 a year and you got 30 years to work. Okay. $250,000 a year times 30 years is $7.5 million, I think.
Okay.
Right.
Let's say that's true.
So you made $7.5 million, okay, of total earnings.
Yeah.
One person at the end of their career, let's say, has a net worth of, I'm totally spitballing here because this is where
you're going to get comments on be like, did you know how bad your math was? That's not even possible.
No. Like my math won't be bad.
Okay.
But this is going to be like, it varies so much by the person.
Yeah. Okay.
That like there isn't like a great standard here because some of you with a $7.5 million of earnings,
lifetime earnings,
are going to have like a $2 million net worth or $1.5 million net worth. And some people are going to have
well, it depends like family size and the city you chose to live in and like spending habits
the
and
number of times you're embezzled and divorced, or, there's just so many variables. But let's say $7.5 million of lifetime earnings that someone has, $250,000 a year, 30 years. The person that goes all liquid assets might only have, let's say, a $2 million net worth.
Okay.
And the person that went retirement plans and liquid assets, let's say, has a $4 million net worth or 3.5. It's like, boom, big difference. They succeeded. So both of these people have succeeded in terms of what's possible for their choice or the things that they did. And then someone that does, let's say someone that went all practice. Okay?
Meaning they like lived on the minimum that they could take from their practice and put all the net profits back into growing the practice. In that scenario, you better have a net worth that's bigger than 4. Yeah.
Okay? Because
it should probably, is it fair to say it should probably be bigger than your lifetime earnings?
It should be as good or
as your lifetime earnings
or better.
Because the risk is so much higher in a private business, the return has to be bigger.
Yeah.
And if you did it well, you got a bigger return than other types of investing. So that'd be fair.
Now, most people will do some hybrid of all of these things, but we're just talking in extremes.
Yeah,
so
that was the question.
All in practice, then someone who's successful would have a net worth that far exceeded the other possibilities, right? The people that could have just gone liquid or just with retirement accounts or a combination of those two. But it shouldn't be like way less than the liquid person. And that's the challenge that we typically see, is that the successes and the outcomes on someone who pursues the entrepreneurial path varies a lot more.
That's the risk of it.
So you're either going to have someone who's failed
bombed
or someone who's done really well. But, there's not really like a great average. The average is like, if you're going to kind of be someone that says, I want to have a location, maybe 2, and I want to hire an associate or 2 or a handful, you're probably still going to want to build liquidity.
And they probably still will.
In that model, and you probably still will.
They will.
So the pros are you can have exceptionally high
net worth. Yeah.
Like you'll have a significantly higher net worth. You'll pay capital gains tax on the sale of that business asset. It's the lowest tax rate available.
And you could be done sooner.
And you could
big and
be done a lot sooner. And maybe that fits your personality, And a lot of these are like what fits you.
Yes.
But the downside of that is you're carrying until that moment in time. Like until that moment in time of that sale, in that liquidity, when it goes to LT, right, you don't know. And you never know. And it's always a little stressful.
Yeah.
And so the advantage of the LTQT saver along the way is they're just taking a little off the table all the time.
That's true.
Just getting a little off the table, building that net worth predictably. And the alternative is someone that's just kind of kicking the can down the road going,
I'm going big.
I'm going to make this thing happen.
Yeah.
And it can be some hybrid too. Like, okay, we're not saying that can't be some middle ground. But if you build a big practice term, you will have a lower savings rate, okay? Because you're
like technically on paper. Now, like if we went back into the P&L and we said, what did you actually take that could have been profit and leave it back in your business to hire more associates?
I take that back because Ryan and I don't consider
that's harder to measure
contributions into the practice is really like
it's not going to get reported as like you saved that percentage last year. That's
No.
harder to, but you didn't blow it. I mean, you invested it into something.
Yep.
But that's harder to measure.
Yep. So that's those are some of the pros and cons of that one.
The last one is real estate term.
Mm-hmm.
So how much of your net worth is sitting in real estate? The pro of being overly weighted in real estate.
Yeah. What is it?
What would that be?
Go ahead.
I would say.
You can't think of one.
I'm having a hard time.
I got one. If you're forcing
here's
it.
the one I was going to say, but I don't know if like how many people are going to relate to this. But this is just the first thing that came to my mind is I think that person has an above average like emotional value that feels better about having tons of real estate, because real estate's a very emotional, very tangible asset. Statistically, it's not the same as growing a private business. It's not the same as a public market. But it's a very different tangible and emotional thing. So I think a person who has a big net worth in real estate just has a different emotional tie to their assets and their net worth than someone who's just got like a big portfolio of stocks and bonds and a brokerage account.
You're saying it feels better?
It feels different because I don't know, the person that's got $4 million in a brokerage account.
Well, I think they think
and real estate probably feels pretty good too.
Well, I just think it's subjective, right? I think the person that owns all that real estate a lot of times feels better about it, right? I think they feel better about owning that type of property than if they had a bunch of stock.
Yeah, I think so.
Yeah. And so
it's a different emotional component. It feels superior.
Yeah, if you
I'm a better investor.
If you feel better about owning property, if you feel more confident owning property than you do having a mutual fund, like if you feel like that, let me tell you, that's an emotional reason.
Yeah. Uh-huh.
Now there's some practical financial reasons too why it could be a pro. And the pro is if you're really, really if you've really, really been in a good market for real estate, meaning all the rentals you've acquired, man, you have had really great luck with your repairs. You've had really great luck with your acquisition prices.
Your tenants.
Your tenants have been amazing, and you've been able to charge well above average rents to all those people. You could probably arguably have a pretty dang good return from your real estate portfolio. It's in that way, it's similar to a small business, like your practice term kind of concentrating your wealth in real estate. It has the possibility of having a higher than average return if all of your chips, kind of fall the right way. But if you take the average return of real estate, then the average rent and the average cost
and the average person's experience
and
rents and
then
repairs,
it typically is not as successful as a public market would be, a stock market, for example. It'll be a higher return than a bond market or a safe, and it is a little more. The other advantage of it, I'd say, is it feels a little stodgier.
Yeah.
Especially if you have rents coming in.
Mm-hmm. It feels like it's harder to take away from you.
Yeah.
Because it feels like you have more control because it's a physical thing.
Yeah. And you and I have talked about this before. I think there's some advantages for some people in accumulating more in real estate, both psychologically and based on their experience level and just their interest in what they want to do. For most people, I would say, unless you're going to make that be the replacement for and really focus on it. I mean, you've got to have some diversification in your real estate portfolio for it to really not be super risky for you during your retirement.
Mm-hmm.
I mean, I've seen nightmare stories happen where two people had too much of their net worth tied up in one building or one piece of land that at one point was looking great, but during the wrong market cycle or the wrong tenant or the wrong natural disaster or the wrong, lack of insurance coverage, the wrong liability event, there is more risk in it. And so As a general rule, I'd say the cons are it's more concentrated. It is riskier. It doesn't perform as well on average to even public real estate. Like if you just bought the Vanguard REIT index, like the VNQ, buying that index typically will outperform owning physical property. And so you can get the exposure to real estate that, public market exposure in real estate is very different than buying a rental on the corner of the city that you practice in terms of how the sequence of returns that are going to occur. A private piece of real estate that you own, you know that story, the history, what your market cycle is going to be a little bit. You got a better understanding of who the tenant is. It just feels more tangible.
Mm-hmm.
But
yeah, it feels different.
I'd say the con is it's less diversified. It carries more liability. And for most people, there's a pretty big opportunity cost by investing money in real estate. It's a pretty significant one for a small business owner,
especially most dentists.
Yeah, you need the money in that we talked about the practice not maybe getting enough.
Yeah, your expertise could go probably a longer way in the practice growing something in dentistry than anywhere else.
Yeah. So anyway, those are some pros and some cons.
Yeah, I was just thinking of a couple things that are tough about those two illiquid ones. Anything illiquid, your cash flow is always at the mercy of just whatever the net income is from that asset. You can't go get the principal. Even if you have a massive DSO, until you can actually liquidate it to a seller, you can only get what the cash flow is. And same with a building or real estate. You only get what the rents are.
Yeah.
And so if you needed more than the rents are, it's just, kind of stuck in that position too. So, but they're all trade-offs.
Yeah.
It's all trade-offs. Okay, so maybe let's wrap up with how does the because a few people are going to be like the extremes in one of those areas, and I think some of the extremes are going to be in the two illiquid ones.
Yeah,
they're going to be real estate and private business. You're just going to have the entrepreneurial DSO builder, or the just like I'm in love with real estate person. Those are going to be probably the two, the two like more extreme versions of those.
Yeah.
But for the average dentist who's going to be balanced in all of those things, maybe what are some closing takeaways that are practical to kind of like keep in mind?
Well, if it were me, I would try to remember to focus on building the assets in the right order. That would be something where I would strongly encourage people to think about what order they're going to spend down and build. That's critical.
Yeah.
Because the order that you're going to spend down for most people is going to be they're going to liquidate their practice.
You mean the first things you're going to start getting at in retirement when you're done?
The first assets you're going to spend down or sell, you're going to sell the practice most likely. You're going to get this lump sum of cash. And that lump sum of cash, you don't have a very long time horizon now to invest that money.
Because it's in cash already. It's taxed.
Yeah, and you knew that you wouldn't have a long time horizon. So hopefully you've set up your whole financial plan to know that you're going to have this liquidation event, and you've known how much you're going to get. Like your financial planner's looking out into the future and going, we're going to get 710,000, or we're going to get 550, or we're going to get 1.6, or this is the liquidation. And
build everything else around that expectation, but dynamically, because it changes over your career.
Yeah. And you're going to be planning for that number that you're going to get when they sell it, and you're going to not be able to, because you're going to get that number, it's going to allow your other investments to grow longer, your qualified plans to grow longer, and your liquid assets to grow longer, and your real estate to be deferred, and you won't have to sell that or liquidate it or get equity out of it as soon. And so you're going to spend your practice proceeds first. You're likely then going to turn to your liquid assets second.
Mm-hmm.
And then you're likely going to go for your qualified plans.
Yep.
And then your real estate if you need it.
Unless it's rental and there's some... but liquidating real estate, you're saying.
Well, yeah, I probably wouldn't want to liquidate real estate before I've liquidated all my retirement accounts.
Yeah.
Just because I'm going to pay tax at a... I don't know, though. It depends. Real estate and retirement accounts, close. But definitely practice goes first, then my liquid.
Yep.
And then depending on my basis and what my income tax is.
And are you going to sell the building, or do you... It's funny how many people, by the time they get to that point, they thought they'd always hold a building for rent. But by the time they're ready to wash their hands of a practice, they kind of feel the same way about the building as soon as the buyer is able to be in a position to take it off their hands.
Yeah, they kind of... Well, you're saying why don't they hold it? Why don't they typically?
Well, and I'm also saying that those plans change. Like, it's kind of surprising how often the plan is to hold it, but by the time they get there, kind of just like,
Yeah, and I don't know
I wanna
why
be done.
that's the case. Sometimes they just need the liquidity again
need
because
it.
they didn't accumulate
yeah, and the
enough. 'Cause
$2
they put a
grand,
lot of it
yeah,
in there,
The rent isn't enough. What
Yeah.
they need. Yep.
and they don't want to repair the thing, and they don't want an association with the tenant.
Yeah. They just want to be done.
Yeah. So anyway, if you're going to withdraw in that order, then you want to accumulate in that, in a similar order.
Mm-hmm.
So you want to put your money into your practice
Right off the bat. right
early in
the
your
beginning.
career so that you get your income up as high as possible. Because earlier what we were saying was, let's say you make $250 a year over 30 years, that's $7.5 million. Well, what if it takes you,
Yeah, 5 years.
5 years to get to your
250.
maximum income level, or
Or
whatever
what if you could have made 300 instead of 250?
whatever your
Most of-
maximum income was going to be.
Get it there
Right.
sooner. Yeah.
Get it there sooner so that your lifetime earnings are higher,
Yeah.
and that way you make use of the practice for the longest period of time,
Mm-hmm.
and you get nice tax deductions from that, and then I would probably want to start building my liquid assets more significantly, making sure I had a strong kind of portfolio of liquidity to either, because you never know like what kind of a practice owner you want to be. Do you want to be a high growth owner? Do you want to be a DSO? Do you want to just have two locations, one location? And so having a little bit of liquidity lets you have some flexibility. If it all goes into retirement accounts or all goes into real estate real early, you don't really have like as much flexibility.
Well, the other thing I like about that piece of advice is most of the time, a dentist doesn't have an opportunity for a really big retirement plan, like a pension or cash balance or profit sharing, till they're older anyway, like 40s and 50s.
Mm-hmm.
So, I mean, if you can, in the earlier part of your career, build the business and your liquid position, so that when you hit a point where a pension might make sense, that you're balanced enough, or you could put every penny of your monthly savings into like a big pension
You
or
can
something.
shift it all.
Yeah, because you're like, well, I'm not doing this at the expense of liquidity because I already spent 15 years building liquidity. So I can spend the last 15 years just pumping this thing into pre-tax retirement accounts and have even more left over.
Wiping out a very significant portion of my tax bill.
Yeah.
Yeah, you can see how the order of spending affects the order of accumulation. I said first build the practice, then build liquid. Then I would look at qualified. And if you're really trying to build a real estate portfolio, arguably you wouldn't want that to come prior to the practice. And you don't want it to come prior to building some meaningful liquidity. So, usually what I see if people are serious about real estate, it usually comes at the cost of building more retirement accounts, more qualified assets. And I like it in the order of build the practice, then build liquid, and qualified, and then focus on real estate as kind of a capstone piece or a place to park money later on as you've accumulated and your practice is really humming and you've got nice liquid assets and you've brought your taxes down through good qualified plans, because you don't get to bring your taxes down as much by investing in real estate as you do in retirement accounts.
Yeah,
I'm not opposed to it. It might sound like we're a little anti-real estate on these last two. I'm not opposed to it. It's just that for a lot of people, real estate really is like a small business that you have to start. It
if it's going to be meaningful.
In order for it to really be meaningful, you've got to pursue it with some level of passion. You can't just be like, I own 1 or 2 properties.
Yeah.
You've got to get your whole net worth,
But
tied
that
up.
flies in the face of spending 10 years in school and $1 million in debt for student loans and a practice and
Yeah. It's conflict. It's a conflict of
give and take.
You're not taking advantage of the opportunity you have in front of you as much.
Yeah.
And so I like that. And I think in order to do all those things, you got to be careful not to accelerate your debt payoff too quickly. So in order to make all these things happen, you really got to pace yourself and not just focus on your debt reduction as such a high priority.
Yeah. So the invitation, like going back to the first question, is how do I know if my money is going to the right assets? Then the only way to really know that, the invitation is you got to get organized first. And you got to have someone who's spending enough time, like organizing all these pieces in enough detail that it can be tracked and analyzed. And then when decisions come up, like, oh, we've got years of data in all these pieces to make that decision.
Like, okay, if the practice is the first place to go, how do I know when it's good enough? Well, it depends. I mean, we got to look at your market. You have to look at your specialty. We have to understand and compare you to other people with your hand speed and your competency level, and kind of go, I just don't think you're taking advantage of the opportunity you have. Got to look at your operatories. We have to look at your market, your fee schedules. You've got to have it wouldn't be just a financial advisor that you need. You've got to make sure you have that kind of validation coming from
different,
other
experts.
people, other coaches and consultants that kind of can verify to you that like you really are operating at maximum capacity here. The practice is healthy, or at least above average. Doesn't have to be like optimal, but like above average, it should be.
Yeah.
At that point, then we have a lot of other choices we could make.
The reason why I think a lot of this stuff does not get done is because analyzing this stuff or organizing the data to figure it out is not an event that just you do once.
Yeah.
Because as soon as your collections change, or your spending, or your income, or you took on another debt, and as soon as anything changes at all in your situation, you have to like reorganize all that data and reanalyze it all. So every year that goes by, this stuff changes. The building decision from last year won't be the same building decision as it is next year, even if it's the same building.
Yeah.
Because there's so many moving parts, and that's just it's just really time consuming to do that. So,
well, I like it. It's good closure.
So here's what we do then, Reese. Here's the deal I got for you.
Okay.
Well, you said 10 people get T-shirts.
Okay.
So go to our Facebook group. I thought this was a great question. I had a fantastic time recording this episode because of such a good question.
Yeah.
Okay. So invitation number 1 is go join the group and post a question. And if you post a question that is like even more private, it needs more attention to detail, like we'll take this private message and we'll talk to you directly. It's kind of cool. So dentistadvisors.com/group and go in our Facebook group. Or something that might be even more helpful for you and be more direct and personal is just get on our calendar. So go to dentistadvisors.com, click the big green button that says book free consultation, and schedule a time on our calendar, and let's have a chat about your situation. And let's talk about your bottom row of assets and where you're putting money right now, and let's help you figure out if you need to make some changes.
Got to come up with a plan.
Come up with a plan. Thanks everyone for listening. Till next time.
Carry on.